Good morning. Welcome back to the Retire Report. I'm Hank Parrott, your host. All right, what have we covered so far? The first three myths, we talked about stock selection, we talked about track record investing, and market timing. These are the types, these myths can hurt you, okay? This is speculating in essence when used by most people and the way that that is done. So these myths that are being put out by the mutual fund industry and by active management are saying that they can pick stocks, that they can know when and get in and out or swap around asset allocation to take advantage of market timing. To please look at what we've done in the past as our ability to do that in the future. All of that are things just to pull you in terms of investing. Now the other part, when you're looking at your 401k, right, what are you looking at? You're looking at past performance, right? 1 year, 3 year, 5 year, 10 year. You're saying these are the ones that have done best. But you've also got a very limited amount of options typically in your 401k to choose from. How do you choose wisely? How do you utilize that 401k to your best advantage? And here's another, costs of investing. So this is the last myth, and this one goes into the cost of investing and how this works and some hidden costs of investing. So first, cost of investing. We'll go ahead and throw this slide up on this myth. Fees incurred by investor to buy, sell, and own stocks or mutual funds. So in this situation, what we're looking is that the cost of investing are any fees incurred by the investor, as I said, to buy, sell, or own stocks and or mutual funds. All right. The other part is what some of these important costs are. I mentioned when I do an analysis when a client comes in fact, let me share with you, well, we'll go to the next slide. I'll skip through this and then we'll get an offer out for you. All right, cost of investing. So there's something called the bid-ask spread. I'm going to explain that. And then mutual fund expenses that are there. So many of the expenses you can see. You can see those in a prospectus. They should be provided through your 401k or your company plan, a TSP, whatever it might be. If you're investing out in the marketplace in IRAs, SEP IRAs, Roth IRAs, whatever it might be, or just in a stock and bond mutual fund or portfolio, again, there are expenses there. You can get a lot of disclosure in the prospectuses, of course, with regard to expenses, but there's some hidden costs as well, one of those being bid-ask spread. So, for instance, on the next slide, we see what happens when you've watched the stock market, right, or you watch on TV and you see the floor of the stock exchange and the people running around in the colored coats and all that. Basically, the market makers. So, if you look at the sell price, when a stock sells, say in this situation for $49.50, the person that bought the stock paid $50 for it. The person that sold it got $49.50, and the 50-cent spread went to the market maker. And now what happens if you do what's called a round trip, where you bought and sold something? Now it's 50 cents times 2, or $1 per share. Now, how many times might you do that? And you might think that you can sell those shares directly. You can't. You've got to go through the market. This is the way it works. And here's the other part. In your mutual funds, what that looks like. So when someone comes in and we're doing an analysis, one of the things we look at is, I mentioned, how many stocks are held within that particular mutual fund, and the other is what's known as turnover ratio. And the turnover ratio tells you how many times they've bought and sold stocks within that, and that's what gives you some indication of how high your trading costs may be. So on the next slide is an example. If you're looking at large companies, okay, like the S&P 500, because of the cost, the amount that's being paid relative to the cost of those stocks, it's only about 4 basis points. So it's not a tremendous expense on that particular asset category. But if you look at small or micro companies, you can see a 13 basis point or even 33 basis point difference there, because of the ratio of the fee doesn't change, but the cost of the stock and what that amounts to. So here's where, when you're looking at 33 basis points, or in this situation, let's say a round trip where you bought and sold a stock, 66, that's 2/3%, in other words, that has been incurred in cost. And in how many times might that happen in a portfolio? And you could be talking all of a sudden 2, 3, 4, 5% a year in trading costs being generated within a portfolio. So let's take a look at the next slide. Bid-ask equity spread, costs you may not see. So as a percent of price, an estimate of actual trading costs. This estimate is over 8 times as great for the smallest market segment as for the largest segment. So again, it's so expensive, and it's an unseen cost of investing that takes away value from your portfolio every time it happens. So this even applies to no-load funds. So let's look at the next slide on consumer no-load funds. The key question on the new rules of the game is this: how much better must the active, because this is the key, right? Load and no-load simply has to do with the upfront sales charge, if you will, okay, that is charged in load funds, and that can be, again, it's disclosed. You'll see it on your statements, on your prospectuses rather. 5.75. If you come into my office, and I'm going to put an offer up for you again, I'll show you exactly what your costs are. If you have load funds, I'll share with you which ones are load funds and what those sales loads you paid up front would have been. The next is we'll talk about the no load funds. So we still have costs associated because they're actively managed. You're still doing trading costs in there as well. So again, no load simply means you're not charged a separate commission for purchasing fund shares. It does not mean you're not paying the commissions and the bid-ask spread charged on each security sold for the fund's portfolio. So again, as explained in Charles Ellis's book, as we discussed earlier, when it comes to any mutual fund, load or no load, what we can't see can hurt you. Ellis went on to say the key question under the new rules of the game is how much better must an active manager be to overcome, and the answer is dawning. This is where, again, we get into 2 and 4% and stuff. Total expense ratios of no-load mutual funds, by the way, average 1% before trading costs. So that when transaction costs are added to a fund's expense ratio, it can easily represent 4 to 5% of your investment money. That's 4 to 5% that they have to beat the market by to be able to give you any premium on your investment. So no-load mutual funds are not free. All right, we'll take that away. So let's offer up again. If you would like to get an investment analysis, and I'll show you the reports on your individual funds, on your individual investments, we'll run a portfolio comparison that'll show what your mixes are. It'll show on the individual reports what stocks you own, what the turnover ratio on those stocks might be, how many stocks, for instance, in bond funds. I'll show you how many of them are investment grade bonds, how many may be junk bonds, and the duration of those bonds, because the longer the duration, the more interest rate sensitive that portfolio is going to be, or that bond fund is going to be. We'll show you that. We'll also show you if you've got overlap. You know how many times I see, almost daily, when people bring in their investment portfolios, their statements, and we break them down, we have another report we do which shows how many of if you've got two large cap funds, almost assuredly they own many of the same stocks. So you've got a lot of overlap. You think you got 20 mutual funds, you're thinking you're diversified, but they own all the same stocks. It's not diversified. Okay? So this is what we've covered so far. Well, first, the first 10 callers to my office, all right? 615-376-5325. Debbie's standing by. She'll get your information. If you'd like to get really see what's in your portfolio at no charge, come to see me, all right? 615-376-5325. Debbie will get your information. She'll send you out a little checklist of things to bring to your appointment with me. Of course, your statements and the like. We'll then do up these reports for you at no charge. For those that come in, I'm also going to give you a copy of my book, 7 Steps to Financial Freedom and Retirement. So when you come in, if you like, you can get a copy of the book, 7 Steps to Financial Freedom and Retirement, Chapter 5. In fact, if you'd like to get it even in advance, just let us know. If you'd like to be able to read it before coming in, we'll do that for you as well, okay? We want to make it as easy for you as possible. And I want you to understand how investing works, okay? I see so many people lose money unnecessarily simply from not knowing how the rules of the game are set up, all right? And that there is an academic approach that works. It can give you the returns you need to attain your standard living, maintain your quality of life throughout your life, okay? For you, for your family, there's a way to do that. I'm going to share that with you. But first, quick break. Join us here. We'll be right back on the Retirement Report.